Hello guys, welcome to my channel. This is the third video of a series of 3 videos about leveraged ETFs. If you would like to check out my other 2 videos on the same topic, I'll put a link to these videos in the description as well as at the end of this video. In this video, I'm going to show you how your investment would do with the strategy of dollar cost averaging, which basically means drip feeding your money into leveraged ETFs such as TQQQ for a considerable period of time instead of putting a lump sum all at once. So dollar cost averaging is a strategy that's widely known because it helps investors take the guesswork out so that you don't have to be so anxious about judging the market as to when the best entry time would be. With the highly volatile products such as a leveraged ETF tracking 3 times of daily returns of Nasdaq 100, would dollar cost averaging be the perfect solution in managing the risks imposed by such volatility? Clearly, if you had drip fed £10,000 over the period of 2 years into leveraged ETF around the time of a market crash, instead of putting that £10,000 all into TQQQ at once right before the crash, your investment would do a lot better. But in this video, I want to demonstrate to you how much does dollar cost averaging really reduce the risk? Does it completely take the guesswork out? And what your returns would look like if you had been drip feeding before a crash versus after a crash. Let's see how it turns out. So I'm going to show you 2 scenarios. One is if you had been consistently investing £1,000 every single month into QQQ3 for the time period of 2 years, right before the dot-com crash on the 27th of March 2000, as well as if you had done the same for the 2-year period after the dot-com crash. So my calculation shows that if you had been investing every single month £1,000 into QQQ3 for 2 years from the day before the dot-com crash, your 24,000 total investment would be worth £248,515.88. So that's pretty good return. That's nearly 10 times the return on your money. If you had been putting money in a drip feed fashion for 2 years following the crash. However, if you had done the same for 2 years before the dot-com crash, your 24,000 total investment would be worth £39,918.77 today. So that's only about just over 66% returns. It's clearly not as rewarding as the first scenario, and return would be worse than if you had put all your money into Nasdaq 100 right before the dot-com crash. So all of this is saying to me that timing is extremely important for leveraged ETFs. It makes a huge difference as to how rewarding your investment would be. However, timing the market is impossible. Some people might believe they can time the market, but in reality, it's more down to luck than anything else. So personally, I wouldn't try to time the market. The whole reason why I'm doing all this research is to educate myself, to keep reminding myself how deadly the results would be if I believed the illusion that I could time the market. I feel that at least with individual stocks, I can do my research, I can make much more of an informed decision as to whether an individual stocks is likely to go bust, resulting in me losing all of my money or a significant portion of it. But with leveraged ETF, I'm completely at the mercy of the market. There isn't a lot of research I can do beyond looking at market news and listening to individuals' opinions as to where the market is going to go. But because it's at such a mass scale, nobody can predict where it's going to go next. Whereas with individual stocks, I feel that I can have a sense of whether this company is likely to succeed or not by making a judgment on its product, on its earnings growth, revenue growth, as well as characteristics and trustworthiness of its management. But with the market, it feels to me that the research would just be too vast a task if I really wanted to get to know the nitty-gritty of it. And to me, the whole point of investing in the whole market is to take the guesswork out, is to take the anxiety out, because over the long run, the market had always recovered. But leveraged ETFs such as QQQ3 seems to take that safety net away as well. So I'm sort of left with not being able to do detailed research, deep dive research to provide some certainty and a sense of making an informed decision. And at the same time, it also takes that safety net away that normally comes with index funds. Because if we suffered a major crash like the dot-com bubble crash, I could be facing the loss of nearly all of my money even 20 years down the line. And that's not something I would like to go through. However, I guess I'm not ready to completely give up on leveraged ETFs. It is thrilling and it does have the potential to vastly outperform the market when the timing is right, even after major market crashes. So I don't want to be completely out of the game, but after doing this research, I would no longer be willing to dedicate a significant portion of my portfolio to leveraged ETF. I would probably leave a small portion in there and really follow the rule that if I had lost nearly all of that money for decades, it wouldn't hurt at all. It wouldn't affect my emotional stability. I guess that's how I measure my risk tolerance in risky products like leveraged ETFs. So what do you think about leveraged ETFs? After looking at the numbers, do you think it's still a risk you'd like to take? Do you think its reward outweighs the risks? If you care to share your thoughts, I would love to hear about it down below in the comment section. That's it for today. Thank you so much for watching. If you enjoyed the video, please click the like button and subscribe to my channel for all my future updates. I upload videos regularly on the subject of investing. I will see you at the next video. Bye!